We're moving into chapter 8 today, and as you can see from the title, it relates to capital gains and capital losses. So we know that capital gains from earlier chapters are taxable at 50%, and that's what we refer to as the inclusion rate. So the inclusion rate for capital gains and capital losses is 50%. And what I sort of cut and paste here on this first page is what was announced in the 2024 federal budget. In the 2024 federal budget, the government had made a proposal that they were going to increase the inclusion rate from 1/2 to 2/3 for individuals, corporations, and trust beginning on January 25th, 2024. Now, this was only a proposal, so this had not gone into law yet. And if I kind of just scroll down here, it says that because these are just sort of proposed rules, this textbook was not sort of cover these proposed rules. So there's sort of always a risk that because these rules are just proposed, there's never sort of a 100% guarantee that the government in power will actually, pass legislation to make them law. And because if you've been following of what's been happening with the political environment, we see that there's sort of a new prime minister that was basically sworn in just recently. And so these rules here um, have now been deferred. What happened was that on January 31st, 2025, the government announced that these rules are now deferred to January 1st, 2026. So they're still in the proposal stage. It doesn't mean that they will go into effect on January 1st, 2026, but they're no longer in effect for 2024 and 2025. So you don't have to worry about this. I kind of just put this on here just to alert the class that this was something that was supposed to have been law for 2024, but because it was only in the proposal stage, it never got passed. These rules have now been sort of put back on the back burner, and if they do come into effect, the earliest will be January 1st, 2026. So nothing to worry about with respect to the what we're doing in today's class. Jonathan, you had a question?
Yeah, I just had a question about like mentioning that it's in the proposal stage. Will
Mhm.
that be, will any of that be on like tests or homework or anything?
No, so this one page here will not be examinable because it's actually no longer going to be enacted um, until 2026 at the earliest. So don't worry about this one page here for any exams.
Okay, thank you.
Yeah, you're welcome. So that's all I wanted to sort of mention about this one. What we're going to jump into first then is talking about principal residence. Generally speaking, when a taxpayer disposes of their principal residence, that gain will be tax-free. Now, any losses will be denied as well. So with principal residence, any losses will be denied, basically because a principal resident is known as personal use property. And we'll sort of talk about personal use property on the third handout today. But whenever you sell personal use property, such as used furniture, maybe your car, um, generally personal use property will be sold at a loss. When you buy a car, you sell it 20 years later, it's going to be sold at a loss. You sell some old furniture because you're moving, it's going to be sold at a loss. So any personal use property sales, losses will be denied. With principal residence, though, most individuals, families will buy a house to live in. They'll sell it several years later because real estate, generally speaking, does in the long term go up in value. Most of the time when you sell your principal residence, it will be a capital gain. But the government put in a law saying that when you sell a principal residence, it will be tax-free. But there is sort of a caution that we have to sort of step back from that statement is that generally speaking, if a family unit only owns one principal resident at a time and they sell one and then they buy a new one, those gains will be tax-free. But there could be a situation where maybe a family has a home in the city and they also have a vacation home on one of the Gulf Islands, and both of them could be considered their principal residence. They're not renting out either property, and they own it at the same time, and then they go to sell one or both of them, then there could be a situation where some of the gains may be subject to tax. And that's sort of what we're going to look at today. But this is sort of the formula that we have to use. A minus A times B over C minus D. A is the total capital gain on the disposition of your principal resident. B is 1 plus the number of years that you're going to designate that property as your principal residence. And C is the number of years you've owned that property. And this is all since 1971. The reason that 1971 is important is that prior to 1971, capital gains were not taxable. They only became taxable in 1971. So if there's a family unit that has owned a property for many, many years before 1971 and they sell it, then they can disregard all the years prior to 1971 because capital gains were not in effect, were not taxable before 1971. Now there's also this D amount. This D amount relates to something back in 1994. Because that was, basically what, 30 years ago, you will rarely see that anymore. So you can just sort of ignore the D. We don't see this coming up in any of the textbook problems. And so don't worry about the D when it comes to exams, quizzes. It will not be part of this calculation. So let's just sort of go through a simple example. Let's say that we have this family unit. They bought the principal resident in 2020. So they purchased the home in 2020. And then in 2025, they sold the home and then they bought a new home. So they bought their first family home in 2020. They maybe outgrew the home. So in 2025, they sold the original home and then they bought a new home. And let's say that when they sold the home, there was a capital gain. Capital gain of 100,000. So we'll sort of go through an example where we have to calculate the capital gain, but let's just sort of say for this simple example was 100,000. So if we look at this formula here, A is the 100,000. So A is the capital gain. Oops, hold on here. What's going on here? A will be equal to the capital gain of 100,000. And then we have B and C. So C is the number of years that the taxpayers own the property. So 2020, 21, 22, 23, 24, 25. That's going to be 6 years. So when we look at the number of years, you have to include the year that was bought and also the year that it was sold. So you cannot just go 2025 minus 2020. If you do, you're going to get 5. You have to add 1 to get 6 years. If you look at the formula here, we have A, 100,000 minus 100,000 times, in brackets, B over C. C is 6 years. Now then we have the B amount. What is the B amount? B is 1 plus the number of years we're going to designate that property as our principal resident. So if you think about eliminating this 100,000 altogether, B has to also equal 6 because we'll get 100,000 minus 100,000 times 6 over 6. That means the capital gain will be entirely eliminated. So what that means is that we have to designate 5 years as our principal residence for the home that was sold. And so those 5 years can basically be the years 2020 to 2024. The reason they have that 1 plus there is for this exact reason. There's likely going to be a year where you own 2 homes. You sell one and you buy a new one. So that means that for the home that was sold, if we designate the years 2020 to 2024 as their principal resident, we'll get all of the capital gain entirely eliminated. So then we'll have 100,000 times 6 over 6. And so that's going to result in 0 capital gain. And once again, the reason they have the 1 plus there is for this exact purpose, because then the new home that was bought, they can use 2025 as their principal resident. So generally speaking, if a family unit has a family home, they sell it, and then in the same year they buy a new home, they're not going to have to worry about paying capital gains on the disposition of their principal resident. Now, this becomes a little bit more complicated if they have two homes that qualify as their principal resident for several years. Before we go into the example, are there any questions about this simple example that we just did? So then let's look at this question here. So we have the taxpayer, Stuart. He's lived in Vancouver most of his life. In the year 2000, he bought a home in Vancouver for $125,000. In 2005, he bought a cottage in Whistler for $40,000. Now he's lived in each of the homes for at least a portion of the year. So when he's not in the homes, they are vacant. So what that means is both the homes will qualify as his principal resident. So he didn't rent them out. He lived in them both each year, even though he wasn't there full time, because he was in both of the homes during each year. Each home would qualify as his principal resident for all the years under consideration. And then in 2024, he sold both of them. The one in Vancouver for 915, the one in Whistler for 720. And so he wants to minimize the capital gains from the disposition of these two properties. So what we're going to do is go through the steps about how we can use the principal resident to the most advantageous way to minimize his capital gain on the sale of both properties. So the first thing we have to do is figure out the capital gain. So we take the proceeds minus the cost. So let's look at the Vancouver home first. That was sold for $915,000. The cost was $125,000. Now, if there was a sort of any commissions, we would have to subtract those as well. There wasn't. So all we do is just add that up, and the capital gain is $790,000. Let's do the same thing for the Whistler cottage, sold for $720,000. The cost was $40,000. We're not told of any commissions, so we'll just sort of put that as 0. Capital gain was $680,000. So that's the starting point. What we want to do next then is figure out the capital gain per year that it was owned. So if you remember from the Vancouver home, it was bought in the year 2000 and it was sold in 2024. Now, once again, because we have to include the year 2000, we can't just go 2004 minus 0. We have to include the 2000 year as well. So if you do go 2024 minus 2000 and you get 24, you need to add 1 year because the number of years it was owned was 25. So what is our capital gain per year? 790 divided by 25 years. The capital gain per year is 31,600. For the Whistler cottage, it was owned from 2005 to 2024. Once again, if you go 2024 minus 2005, you're going to get 19. You have to add 1 because you have to include 2005 as well. So that one was owned for 20 years. We do the capital gain per year as well. And that's going to give us 34,000. So even though this has the lower capital gain, we want to eliminate the Whistler cottage capital gain first because it has the higher capital gain per year. So what does that mean? We want to figure out then this Whistler property, how can we bring the capital gain down to 0 by designating that property as the principal residence for all years except for 1. And the reason we say for all years except for 1, because if you remember the B in the calculation above, the B is 1 plus the number of years we're going to designate it as our principal resident. So let's sort of look at that formula again. So let me just sort of bring the formula down here again. We can just once again disregard the D. Oops. Here's the formula. So once again, the A amount is the 680,000. So that's our A amount, is the 680,000. The C number is 20. So we own the property for 20 years. Sort of disregard the D, don't have to worry about D. That was something all the way back in 1994. We rarely see that these days. So if you think about the formula, we're going to have 680,000 minus, in brackets, 680,000 times B, oops, over C, and C is equal to 20. And we want this to equal 0. So in order to get that to 0, B must also equal 20. And B is going to equal 1 plus the number of years designated as our principal resident. So all that means is we only have to designate 19 years for B as our principal resident. Because once again, there's some overlap here, right? There's some overlap between when the properties were both owned. So what we could say is that we're going to designate 2000 and let's say 6 to 2024 as our principal resident. So that would
Ronald, I'm
be
just
our
curious.
19 years. Yeah, go ahead,
I
Sam.
wanted to ask, so there's no prorating, so we just take, even if it's bought in maybe November, we would take the entire year.
Yeah, no prorating. You're
Okay,
exactly
thank
right.
you.
Yeah, so that's a good question. Yeah, we don't have to prorate. Yeah, we don't prorate with this. So in order to eliminate this entirely, B has to equal 20. And because of the plus 1, we're only going to designate 19 years for B, for this Whistler property as our principal resident. So we'll use the years 2006 to 2024. And then once again, we go to the formula here. B is going to be 20. We get 20 over 20. And so all the capital gain on the Whistler property will be eliminated. Now, there still is a reporting requirement. The taxpayer must still report the disposition on the tax return, even though the capital gain is going to be 0. So there still is a reporting requirement that was put in place in 2015, I believe. Prior to that, you didn't even have to report capital gains on the disposition of principal resident if it was 0. But I believe it was starting in 2015. Even though the capital gain on this Whistler property disposition is 0, it still must be reported on the tax return. Any questions so far? So then we have to deal with the Vancouver home. For the remaining years, we can designate the Vancouver home as the principal resident. So let's look at the Vancouver home. A is going to be the 790,000. So let me just put that on the other side. So A is going to be 790. C is going to be 25 years. So C is going to be 25 years. And then for the Whistler so the Vancouver property, B will equal 1 plus the number of years we're going to designate the Vancouver property as our principal resident. So we've already used 2006 to 2024. So all that we leave for the Vancouver property is going to be the years 2000 to 2005. That's going to be 6 years because the Vancouver property was bought in the year 2000 and we can only use up to 2005 because 2006 to 2024 was already used for the Whistler home. So if we think about the formula then for the calculation for the Vancouver property, A is 790,000 minus, in brackets, 790,000 times B over C. B will be, this will equal a total of 6 years. So 6 plus 1 is going to be 7. So we're going to designate 2000 to 2005. Once again, we have to include 2000, so that's a total of 6 years. Because of the plus 1, we're going to get b equal to 7 over a total of 25. And that's going to be our calculation. So when you work through that, we're going to get 790,000 minus the reduction of 221,200. That's this calculation here. That's 221,200. Just double check that with your calculators. Yeah, 221,200. So therefore, the capital gain that will be taxable is going to be 568,800. So that's going to be the capital gain that is subject to tax. And once again, we multiply that by 50%. And so the taxable capital gain is going to be 284,400. So this is the amount that's going to go into 3B when the taxpayer is calculating their net income for tax purposes. And so when it comes to principal residence, the only complication arises if the taxpayer owns more than one property for several years and both qualify as their principal resident. And so that's how you sort of deal with it. Figure out the capital gain first, then figure out the capital gain per year. The property with the higher capital gain per year, we're going to try to eliminate all of that capital gain. And then once we do that, for the remaining years that we have available, we'll designate the remaining property as our principal resident and reduce the capital gain as much as possible. Any questions about this example?
Hey, Ronald, so it's a
Mhm.
50-50 split based on this information. So basically, if it's any other variance, it would just go, you just designate it to the principal then? Or like, how would you go about that?
So I missed the first part of your question, Hayden.
Yeah, so since they're this question's a 50-50 split, so then I'd assume that like any other you know, time spent, like if it's like a 60-40, then you just use
Oh, I
common
see what
sense
you're
there.
saying.
Or
So,
like what, how do you kind of guarantee or
yeah,
decide
so
that?
it doesn't have to be that you spend equal times at both properties. Is that what you're asking?
Yeah, just because
Yeah.
this question stated like that split. So
So it didn't state that he spent equal time at both property. He's just saying he spent at least a portion of the year living in each property. So it doesn't mean that he has to live 50-50 at each property, but in order to qualify as a principal resident, you can't sort of be renting it out, full time, and you basically have to be inhabiting the property during the year. So he could have been spending maybe his vacation at the Whistler property, maybe 4 or 5 times a year. And during that time, when he was not there, it was basically vacant. So it doesn't have to be equal time at both property, as long as it qualifies as a principal resident because he and his family lived there and it was not used for any other purposes such as rental, it would qualify as his principal resident.
okay, yeah, that makes sense.
Okay, yeah. Any other questions before we continue on? Now, this is sort of an interesting topic because a lot of taxpayers, because they know that property prices increase in value, they may try to use this to their advantage by saying that this property that they bought and lived in for a short period of time was their principal resident and try to basically eliminate the capital gain. What I posted on eLearn, I'll just bring up eLearn quickly. I just posted it this afternoon because I remembered this court case. If we go to eLearn quickly, so we're here now in chapter 8 this week here. Right at the bottom here, I just posted this court case summary for this taxpayer, Mr. Hansen. This will not be examinable. This court case will not be examinable, but it's an interesting read. Mr. Hansen and his family, I believe they sold 5 properties within a short period of time, within maybe like 6 or 7 years. And each time they sold the property, they declared it as their principal resident, and each property had substantial capital gains. And when they filed their tax return, they said because of the principal resident exemption, they didn't have to pay any tax on the capital gain. This went to the Tax Court of Canada. And if you read through it, you'll see that for the last two sales, property 4 and 5, the tax court basically agreed with the CRA and said that Mr. Hansen acted as sort of in a business-like manner, and there was no intent to be living in there for a long period of time as their principal resident. Even though the family lived in these homes, one of the main intents was to profit from the sale. And so this is one where even though the family did live in the home, the tax court agreed with the CRA and denied the principal resident exemption for the sale of the last two homes, properties 4 and 5. So a bit of an interesting read if you want to just sort of read that at some point and just sort of see how this can sort of apply to a real live situation. It talks about the fact that the CRA actually interviewed neighbors of the family where they lived to see if I think some of the arguments that the taxpayer was saying was that there was coyote problems in one of the properties. That's why they sold it. Another property that they sold, they said the neighbors were really, really noisy. And so the CRA actually did contact neighbors of those properties to see if these these arguments were in fact true. So a bit of an interesting read, not examinable, but something that sort of sheds a little bit more light on how this rule can be applied in the court of law. We're going to move to handout number 2 next, which I believe is this one. No, that's number 1. Where's number 2 here? This one. So this is handout number 2. This is a bit of a more complex handout. This sort of deals again with capital gains and capital losses, but these are a bit more advanced type topics. So I thought we'll get through this one first, and then we'll do the third handout after the break. So this first topic talks about a rule that applies when you sell real property. So when we talk about real property, we're talking about building and land. So whenever you hear the term real property, basically it's building and land. So it could be a house, it could be an office building, it could be a condominium. And this rule basically applies to all taxpayers. Some of the rules we're going to look at only applies to individuals, but this one applies to all taxpayers, individuals, corporations. So let's sort of go through this question here. We have this corporation. They bought an apartment complex in 2021 for $450,000. Now, when you buy real property, you've got to apportion the value between land and building. Because remember, only the building portion can you take CCA on. Same for accounting purposes, you can only take depreciation on the building, not on the land. So of the 450, 100 was for the land, 350 for the building. A few years later, they sold the apartment complex for 460, and they apportioned 120 to the land and 340 to the building. Let's just say, for argument's sake, the total CCA that was deducted over the years on the building was $7,000. So the building was put into class 1. We bought it for $350. Over the years, we deducted $7,000 of CCA. So at the beginning of 2024, this was the UCC. The land, we bought it for $100,000 and we sold it for $120,000. So let's look at the land first. The proceeds of disposition for the land was $120,000. The adjusted cost base was $100,000. So the capital gain will be $20,000. And once again, multiply that by 50%. And so our taxable capital gain is going to be $10,000. Let's look at what happens with the building next. And this is where Chapter 5 comes into play. Remember when we went through Chapter 5 before the reading break, I said Chapter 5 filters through to many chapters after, including this one. When you dispose of depreciable property, in the CCA class, you have to deduct the lesser of two amounts. The first is the cost. The cost was $350, and the proceeds of disposition was $340. So we sold the building for $340. The lesser of the two is going to be the $340. So we are now left with $3,000, and there's no assets remaining because we sold the building. If you remember from chapter 5, we said that if you're left with a positive amount and there's no assets remaining, this is known as a terminal loss. So what that means is we get a full deduction of this amount from our income, and that will reset this to 0. Yep. So this is if there was no special rules. So this is without the special rule that we're going to talk about. The reason that the CRA, I guess the government came up with this special rule was that if you think about it, in a situation like this, taxpayers might try to allocate more to the land and less to the building. Because if they allocate more to the land, that gain will only be subject to 50% tax, or it will only be, the gain will only be taxed at 50%. And if they allocate less to the building, that could result in a larger terminal loss. So they came up with this rule, which is referred to as the rule under ITA 1321.1a. This rule will basically limit the amount of the terminal loss on the disposition of real property. So let's sort of look at what this rule does. The rule will basically deem the proceeds to be an amount based on this formula. Now, you don't have to memorize this formula. Once again, you're able to use your notes textbook for the final exam. All I would do is just suggest that you work through the formula without sort of, trying to sort of figure out why this formula is the way it is, because it's a fairly lengthy formula. And wording is important. When there is a sale of real property, we have to apply this rule to see what the proceeds of the building are deemed to be. So it's not going to be the 340. It may not be the 340 that we thought it was. It may be something different. The proceeds will be the lesser of these two amounts. So the lesser of the two bullet points. And this is sort of where it gets complicated, because the first bullet point is the fair market value of the land and building. So what was the fair market value of the land and building? Basically, what was it sold for? It was sold for a total of $460. So that's our fair market value because we sold it for $460. So the fair market value of the land and building reduced by the lesser of the cost of the land. So the land had a $100,000 cost, and the fair market value of the land, which was $120. So we take the fair market value of the building and we reduce it by the lesser of these two amounts. So the first bullet point is going to give us $360,000. Then we get to the second bullet point. The second bullet point is the greater of the fair market value of the building. So once again, what did we sell the building for? The fair market value, it was $340. So the second bullet point is the greater of $340, and the lesser of the cost of the building. What did the building cost us originally? It was $350. And then the second one is the UCC of the building before the sale. That was the $343. So once again, it's just a matter of putting in the numbers and then trying to figure out what is the right amount for the second bullet point. The second bullet point is the greater of the first number and the second number. And the second number is the lesser of these two. So when we look at this here, the second bullet point is going to be the greater of 340 and 343. So that's going to be 343. So it's a little bit confusing, but as long as you have the proper wording, you just have to plug in the numbers. And so why are we doing this again? Because we were trying to figure out what is the deemed proceeds of the building. The deemed proceeds of the building is going to be the lesser of the first bullet point and the second bullet point. And so the deemed proceeds of the building is going to be 343. All we're doing is just following the formula. Then we have to figure out whatever is left is the proceeds for the land. So remember we sold the apartment complex for 460,000. Based on this formula, 343 is going to be allocated to the building. So the remaining amount will be 117,000, which will now be the deemed proceeds for the land. So if we apply these new amounts to our calculations, let's see what we get. For the land now, our deemed proceeds is going to be 117,000. Remember the cost was 100,000. So now our capital gain is going to be 17,000, of which 50% is taxable. So that's going to be 8,500. For the building, we have to do the same thing. We're going to deduct the lesser of two amounts. The first amount is the cost. And then once again, the cost was 350,000. And then the second amount is going to be the deemed proceeds of disposition, which is now 343. And if you look at the lesser is going to be 343. So that will basically eliminate the terminal loss. So what we're basically doing is, if I just sort of go up here we had a situation where if there was no special rule, we would have 10,000 of our taxable capital gain, and then we would have a $3,000 terminal loss. And so the net impact would be positive 7,000. With the special rule, we now have taxable capital gain of 8,500. And that's it, because now there is no more terminal loss. So all we've basically done is that we kind of just shifted that terminal loss. This is a difference of 1,500. So all we did was we sort of shifted the terminal loss over to reduce the capital gain. Remember, the capital gain was originally 20,000. So now the capital gain is 17,000. And so in effect, we basically said, well, let's shift the terminal loss to reduce the capital gain, but then only 50% of that will be deductible, because with capital gains, only 50% are taxable. So we kind of basically remove the terminal loss and reduce the capital gain. But the overall impact means that more income will be taxable with this rule that was applied. So once again, it's a rule that is important because if you end up working, let's say, in an accounting firm and you're preparing tax returns for individuals, a lot of individuals will buy and sell real estate. And this is sort of where, if they sell a rental property and we do the calculation that there's a terminal loss on the building portion, then we have to apply this rule to figure out what the deemed proceeds should be for the building and also for the land. Any questions about this application of this rule? And once again, it does come up quite frequently. When I worked in public practice and I was doing personal tax return, this is something that we would see quite regularly with our sort of wealthier clients that do buy and sell real estate. So it's something to be aware of. And once again, this applies to all taxpayers, corporations, and individuals. The next provision, moving on, I don't see any questions coming up, deals with a deferral provision. And it applies when shares in small businesses are sold. This rule only applies to individuals, not corporations. So this is trying to encourage individuals to invest in sort of small startup companies. What it's saying is that if you invest, you buy shares in a small business, and then you sell the shares at a gain, and then you use the money to buy shares in another small business, some of that gain on the sale of the first set of shares might be deferred. But it only applies when you dispose of shares in an eligible small business corporation. So then the question is, what is an eligible small business corporation? So this is sort of the definition from the textbook. We talked about this term CCPC before, Canadian Controlled Private Corporation. As I mentioned before, if you end up taking the corporate tax course next academic year, BFIN 451, you'll learn about what constitutes a CCPC, a Canadian Controlled Private Corporation. But for our purposes, we'll be sort of told that these are CCPCs and that these shares are eligible small business corporation shares. But the definition is that the company that you're selling the shares must be a CCPC, greater than 90% of their assets, must be used to carry on an active business, primarily in Canada. So an active business means that it can't just be passively investing in, let's say, term deposits, passively investing in shares. It has to carry on an active business where they're employing people, where they're actually sort of creating jobs and so forth. And once again, we're not going to get into how will we determine that, because we'll be told in our scenarios whether these are eligible small business corporation shares. But that's the definition of the first part of the definition. And then the second part of the definition, this relates to what do we mean by small. And so what they mean by small is that the corporation must not have assets with value in excess of 50 million. So that's sort of how they determine whether it's a small business or not. So what has to happen is they have to sell some shares in eligible small business corporation. And so in order to qualify, the shares that are sold must be common shares. So they cannot be preferred shares. They have to be common shares. And the taxpayer must have owned them for at least 185 days before they were sold. So it can't just be them trying to flip shares, buy and then sell for a quick profit. They have to have owned them at a minimum for 185 days. In order to qualify for this deferral, they then must use some of the proceeds and buy new shares. Those are known as the replacement shares. Now, the replacement shares also have to be common shares in an eligible small business corporation, and they have to buy those shares within 120 days after the end of the year in which they sold the first set of shares. So they have up to 120 days after the end of the year. So if they sold the shares, let's say this year, they would have till 120 days into 2026 in order to buy replacement shares. So it does have to be bought right away. So the best way to sort of illustrate how this deferral works is to look at this question here. So once again, this only applies to individual. So this individual Chad sells all of his common shares in this company, and that company qualifies as an eligible small business corporation. So it's only on the sale of common shares of an eligible small business corporation. So he's owned the shares for 15 years, so it meets that 185-day period. He bought them for 600,000, sold them for 1.1 million. So let's look at the calculation on January 15th, 2024. This is known as the qualifying disposition. We take the proceeds less the adjusted cost base. And so we have 1.1 million minus 600,000. And so we're going to have a capital gain of 500,000. And so what we're saying is that in order for this deferral to be allowed, he must purchase replacement shares within 120 days of year end, which is December 31st, 2024. So he basically has, approximately 4 months into the new year, so like until April 30th, 2025, to buy these replacement shares. But for our purposes, he bought the replacement shares just about a month later. So he didn't wait that long. And the replacement shares that he bought have a cost equal to 940,000. So then the question is, how does this deferral work? How much of this capital gain can now be deferred because he used some of the proceeds, he used some of the 1.1 million to buy these replacement shares? The amount of the capital gain, the amount of this 500,000 that can be deferred, will be calculated using this formula. So we take the lesser of the cost of the replacement shares and the proceeds on the sale of the original shares. So we take the lesser of the cost of the replacement shares, 940,000, and the proceeds from the sale of the qualifying disposition, 1.1 million. And we divide that by the proceeds, which was the 1.1 million. And then we're going to multiply that by the capital gain, which is the 500,000. So let's look at the numerator of this part first. The numerator is going to be the lesser of two amounts. And in our example, the lesser is the 940. If he had used the full 1.1 million or more to buy the replacement shares, we would have 1.1 over 1.1. All of this would be deferred. But because he did not spend the full 1.1, he only used 940, we now get this fraction. So this is basically saying that if you use the full 1.1 to buy the replacement shares, or you use more than that, all of the capital gain can be deferred. But because you did not use all of the 1.1, the permitted deferral will basically be 940,000 divided by 1.1 million times the 500,000. And the amount of the capital gain that can be deferred will be 427,273. So the majority of it can be deferred, but not all of it. Any questions about the calculation of the permitted deferral? So then how will this all get reported on the tax return? So on that tax return, we have the original capital gain. So this would be on the 2024 T1 return. We would have the capital gain of 500,000. We would have the permitted deferral. So we get to defer 427,273. And so the capital gain that will be subject to tax will be 72,727. Once again, 50% of that's taxable. So the taxable capital gain that will be reported in 3B will be 36,363.50. Now we got to update the cost of the new shares. So this capital gain that's being deferred is not eliminated, we're just deferring it. The way that we defer that is we take the original cost of the new shares. So the replacement shares were bought again for 940,000. And what we're going to do is we're going to subtract the permitted deferral. And this is going to give us the new adjusted cost base for the new shares. And now it's going to be lower. And if you think about it, all we're doing is reducing the adjusted cost base to a lower amount So when these shares are sold, the lower adjusted cost base will result in a higher capital gain. So that's all we're doing. We're just saying that you can defer this amount, but it doesn't mean that it's eliminated. All we're going to do is for the new shares that you bought in the eligible small business corporation, we're just going to reduce the cost by the amount that was deferred. So when you eventually sell these new shares, you have a lower cost. So that means the gain will be higher. And that's sort of when that gain that was deferred will eventually be reported. Any questions about this deferral provision? So once again, these are more complex topics. And so the reason I'm going through them is because even though the textbook does explain them, it's sort of nice to sort of understand sort of what is happening with these provisions. The next more complex topic we're going to talk about, we'll get these more complex ones out of the way first, is another deferral provision. So deferral provision means that we're deferring the recognition of gain or income. And this is on what we refer to as replacement property. Now, this applies to both corporations and individuals. So this one applies to both corporations and individual. Basically, it often happens for companies. They, let's say, have a head office here in Vancouver. They decide to relocate their head office maybe to Calgary. So they sell the head office here in Vancouver. The head office has land and building. There could be recapture, there could be capital gain, but they're going to use the money to buy a new head office in Calgary. So the government says if you are just replacing the property that you sold, as long as you sort of follow the rules, then some of that capital gain and recapture can be deferred. Now, it splits it into two types of dispositions: involuntary and voluntary. So the example that I just talked about, the relocation of the head office, that would be a voluntary disposition. In order for this deferral provision to be allowed, they must replace that head office within 12 months after the end of the year in which the disposition took place. So if they sold the head office, let's say in 2025, they have 12 months from the end of the year, so by the end of next year, 2026, to buy the replacement head office. Now, when it's a voluntary disposition, this deferral provision will only apply to real property. So it will not apply to selling a machine and buying a new machine. It will only apply to real property if it's voluntary. What about the other category, involuntary? What do we mean by involuntary disposition? Maybe there's a theft, a fire, flood of some sort that destroy the property. If it's an involuntary disposition, one of their buildings were destroyed by a fire or a flood, they're going to get some insurance proceeds from the building that was destroyed. As long as they replace that asset within 24 months after the end of the year, a little bit longer because it's involuntary, then this deferral provision will apply. Now, when it's involuntary, it will apply to all depreciable property and real property. So involuntary means that it was not due to a decision that you made. It was beyond your control. There was a fire, there was a flood. It destroyed this building that we had. It destroyed this machine that we had. Insurance will pay for the replacement. That insurance is the proceeds we use to determine whether there's a gain or recapture. And then as long as we replace it with another asset, then some of that capital gain and recapture could be deferred. So this is also another deferral provision. And I kind of just down here, I kind of just summarize the rules. But once again, it's kind of hard to understand the rules without putting some numbers to it. So why don't we have a look at this question here? We have this company, Multi Inc. They have a December 31st year end, and they operate out of a building that cost 815,000. Now, there's a land value as well, but we're just going to focus on the building, not the land. At the beginning of 2023, the UCC for the building in class 1 was 684,275. So that's where we are here. We have this building, it's in class 1, and that's the UCC at the beginning of the year. Midway through the year, the building was completely destroyed in a tornado. So the land was okay. It was just the building that was destroyed. Because of the insurance policy, they received $1 million for the building that was destroyed in 2023. So in 2023, we actually have a disposition. So in 2023, for tax purposes, there's actually a disposition of the building. And the proceeds that were received was the $1 million they got from the insurance. So there was actually a disposition of the building in 2023, even though it was destroyed, because there was proceeds received for tax purposes, there is a disposition. So let me just put that up here. So what that means is we got to figure out then, what are the tax consequences for this disposition? Now, one thing that I wanted to add here is that this is an involuntary disposition. So this is an involuntary disposition because it was, not something that they decided to do. It was a tornado that destroyed the building. Once again, we're just focusing on the building. There is a land value as well. But once again, the land is fine, even though there probably was some damage to the land, they can just sort of rebuild the building on top of the land. So we're not going to sort of worry about the land because the land is still theirs. So with the building, whenever we sell a depreciable asset, if we look over here, we have to deduct the lesser of cost and proceeds. So the cost of the building, once again, was $815,000. And the proceeds, what they got from this insurance company, was $1 million. So the lesser of the two is going to be the 815,000. Oops. And if we work through the math here, we're now going to have negative 166,725. And remember again from chapter 5, if we're left with a negative balance, that is recapture, we have to add this amount to income. Oops. We have to add this amount to income in order to bring this to 0. So that's how we would deal with the CCA class. But also remember from chapter 5, if you sell the depreciable asset for more than the cost, remember we sold it for $1 million, but the cost was $815 and we only used the cost here, there will still be a capital gain. So let's look at the capital gain. Sold for $1 million, cost was $815. So we also have to report a capital gain of $185,000. Once again, 50% taxable. So the taxable capital gain is going to be $92,500. So all of this is happening in 2023. So on the 2023 T1 return, they're going to have to report in 3A the recapture of 166,725. And then in 3B, they'll report the taxable capital gain of 92,500. So even though this was destroyed by a tornado because they got insurance proceeds, that insurance proceeds is known as the proceeds of disposition. And so even though it was destroyed by a tornado, it's still a disposition for tax purposes. And so all of this would still have to be reported on their 2023 tax return. Oh, this is actually a corporation. This will be a T2 return, not a T1. But if it wasn't related to an individual, same thing would apply beyond their T1 return, but this is a corporation, so that would go on their T2 return. Now, if we think about this deferral provision, if it's an involuntary disposition, they have up to 24 months from the end of the year to buy the replacement property. So the replacement is within 24 months of December 31st, 2023, because the tornado happened in 2023. And because this was involuntary, as long as they replace it within 24 months of December 31st, 2023, which is basically 2 years, the deferral provision will apply. They did replace the building in 2024. They built a brand new building, and that building had a cost of $1,075,000. But because of the timing, they still have to file their 2023 return, because when they are filing their 2023 return 6 months after year end, the new building wasn't built yet. So they still have to file their 2023 return and pay taxes based on these amounts here. So then what happens in 2024? In 2024, they have the replacement building worth $1,075,000. And this is sort of where we have the rules that relate to the capital gain first, and then to the recapture later. So let's look at the capital gain rule first. Because there was a replacement property done within the required time frame, the capital gain on the 2023 disposition, this amount here, will be reduced to the lesser of two amounts. And so let's just sort of fill in the blanks. The first amount is the actual capital gain. Now this is important. The wording is reduced to, not reduced by. So what was the actual capital gain? The actual capital gain, not the taxable capital gain, the actual capital gain was $185,000, not the taxable amount. That's the first amount. And then the second amount is the excess of any, the excess of the proceeds of the old property. So how much do we get for the old building? For the old building, the excess of any, the proceeds from the old building, 1 million over the cost of the new building. New building, 1,075,000. Is there any excess? The excess is equal to 0. This second one is saying is, as long as you use the money that you got from the old property and use that same amount or more on the new property, and then this second figure will be 0. Therefore, the capital gain is reduced to the lesser of the two, which is 0. So what we're saying is that the wording is really important. It's not reduced by, it's reduced to. So what we'll need to do is file an amended 2023 return. So remember, this 2023 return up here was already filed. We filed it, we declared the capital gain, the recapture, because we weren't sure, when we would complete building the new property. We finished the new property in 2024. So once it's complete, we can now go to the CRA and says we want to amend our 2023 return, and we basically want to change the capital gain. So we basically want to amend the 2023 capital gain. We want to change the capital gain from 185,000 to 0. Because based on this rule, we can do that. And so what would happen then is, if they've already filed the 2023 return and paid the taxes, they would get a refund once they file this amended 2023 return. This amended here, you would file what's called a T1 adjustment. So you would just sort of go to the CRA website. I guess it would be a T2 adjustment. So it would be a T1 or T2 adjustment, depending on whether it's an individual or a corporation. Because this is a corporation, they would file a T2 adjustment. All they would just say is that the original capital gain was 185, the new one is 0, and then the CRA will recalculate what their income was based on the new capital gain of 0. So that's how we deal with the capital gain. But what about the recapture? Once again, a fairly lengthy formula here. So let's just sort of go through this together. We have the same starting point. 2023 UCC, 684,275. So all we're going to do is recalculate the recapture based on this new formula now. We're going to deduct, first of all, the lesser of two amounts. So we got to figure out the lesser of two amounts, similar to what we did before, proceeds and costs. So the building that was destroyed, we got $1 million. That's our proceeds. The cost of that building was $815. So the lesser of the two is going to be the $815. But now we have to reduce that $815 by the lesser of 1, the actual recapture. So the actual recapture that we reported last year, if we go back up here, that was the 166,725. And the second one is the replacement cost. So how much did we pay to build the new building? That was the 1,075,000. And so let's look at what the lesser of. The lesser is going to be the recapture. So we take 815 minus 166,725. And that's going to be how much we have to deduct from the UCC. So this is going to be 815 minus 166,725. Oh, hold on. It's not working. So that's going to give us 648,275. And this will basically amend the recapture to equal 0. So what we're actually doing here, if you look at sort of what we did, if you look at the original calculation before we applied the rule, it was 648,275 minus the cost. And that's how we came up with the recapture. With this deferral provision, all we're doing is taking that same 815, but minusing the recapture. So that way it will eliminate the recapture entirely. And all this is saying is that as long as you spend at least the amount of the recapture on the replacement building, the recapture will be eliminated, because this is reduced by the lesser of these amounts. If we didn't spend, let's say we only spent 100,000 on the new building, then we would take 815 minus 100,000, and there would still be some recapture that we would have to recognize. So as long as we spend at least the recapture amount on the new building, then the recapture can be all deferred. So same thing here, we would amend the 2023 T2 return to have a recapture of 0. And so once again, we would file a T2 adjustment. We have our original recapture of 166,725, and then amend to now have 0 recapture. And once again, we would just contact the CRA, file this T2 adjustment, and then because we already reported the income on the 2023 return and paid taxes, we would just get a refund once we file these adjustments for the 2023 return. So that's how it will be deferred. We still have to now look at how will that impact the value of the new building going forward. But any questions to this point?
Yeah, so what type of involuntary dispositions does this cover?
So once again, just sort of going back up here, if we have things such as theft, fire, flood, destruction. So the tornado would be sort of destroyed involuntarily. Expropriation, if maybe the government came in and said, you don't have a choice, you have to sell us your property because we're going to expand the highway. That would be a type of involuntary disposition. So as long as it sort of was not planned by the owner, it was sort of beyond their control, then that would meet an involuntary disposition. Does that answer your question?
Yeah, definitely. Thank you.
Perfect, yeah. Any other questions before we look at how will the cost now be impacted of the new building? So kind of similar with this example that we did up here, the cost of the new asset will now be reduced by the amount that was deferred. So what was deferred? The capital gain went from 185 down to 0. So the 185 of the capital gain was all deferred. What else was deferred? The recapture was deferred. The recapture was 166,725. That recapture was also all deferred. Deferred, sorry. So let's look at the cost of the new building. The cost of the new building was 1,075,000. The capital gain that was deferred, the 185, that's going to reduce the costs of the new building. So the new building now will have a cost of 890,000. So this is going to be the new adjusted cost base of the building. So if they were to sell that building in the future, they would use 890,000 as the new cost. But what about the recapture? Well, the recapture is going to reduce how much they can add to class 1 for CCA purposes. So because the recapture dealt with the CCA class, the amount that they can add to class 1 for CCA purposes will not be 890,000. It's going to be 890 minus the recapture. Whoops. It's going to be 890 minus the recapture that was deferred. And so for purposes of CCA, they can only add 723,275 to class 1 for CCA purposes. So the new cost will only be reduced by the capital gain that was deferred, but the amount that we can add to class 1 for CCA purposes, we take the new cost and reduce that even further by the recapture that was deferred. So it's not really technically that hard as long as you sort of have the formulas in front of you and you sort of understand what's going on. But these are, once again, more sort of advanced topics that you wouldn't see sort of every day. These are sort of more things that you would see occasionally if you were working and doing tax returns, let's say in a public accounting firm. You may not see these very frequently. These would just sort of be things that you would see, once in a while. Any questions about this deferral provision? So we have gone through, I think that was the last one in this handout. Yeah, it was. So we have gone through the harder topics now. It is 7:15, so why don't we take a break and then we'll return at 7:25. Any questions before we take a break? So why don't we handout number 3? So we'll take a break and then I'll see you back here in just under 10 minutes and we'll start handout number 3. What we're going to do now is the third handout for Chapter 8. And once again, this deals with other issues relating to capital gains and capital losses. The next topic we're going to talk about is superficial losses. And this applies to individuals. This is sort of a situation when the loss is denied, and it'd be a capital loss. But added to the adjusted cost base of the new property. So kind of like the opposite of what we just did before the break. Before the break, we had capital gains, they were deferred, so then they reduced the cost of the new property. This deals with a capital loss that is denied, but instead of subtracting it from the cost of the property, we're going to add it to the cost of new property because we're denying the loss this year, but we're going to add it to the cost of the new property, which is going to reduce the gain in the future. So this applies only to superficial losses. So what do we mean by a superficial loss? That is one that results from the sale of non-depreciable capital property. So we sell some shares and then we buy back the same shares within 30 days before or 30 days after the disposition. Now, the repurchase can be made by the spouse as well. And if it is, the superficial loss rules would still apply. So why did this rule come into effect? So the reason for this rule is that taxpayers were, let's say, selling shares close to year end that were losing money in order to generate a capital loss. So taxpayers will look at all the shares that they owned close to year end. They saw that certain ones were losing money. So they said, well, let's just sell these shares at year end so we can generate a capital loss and report the capital loss this year. And it will help reduce our 3B amount because we have all these capital gains that we also have to report this year as well. And then what would happen would be the taxpayer would then repurchase the same shares early in the new year. And because shares are identical property, you sell shares in TELUS, you buy back shares in TELUS, a month later, is identical property, right? And so this superficial loss will usually apply on the sale of shares. So let's look at this example here. I'm just going to separate this. Whoops, hold on. I'm just going to separate this between the 2 years. So on May 1st, the individual buys 100 shares in Mir Corporation for $25. Close to the end of the year, on December 20th, they sell the 100 shares for $24. So actually, let me just put this down here. Just going to move this all down here. So let's see what happens in 2023. So in 2023, oops, we have the sale, proceeds of disposition, 100 times $24. And so that's going to be 2,400. The cost, we bought the shares for 25. And so we have 2,500 as our cost. And so there's that capital loss that we were talking about. Of $100. Now, they bought back shares in the same company on January 3rd. So this is within the 30 days. So it looks at 30 days before the purchase or 30 days after. This is within 30 days after the purchase. So what that means is that this capital loss then is going to be denied. Where is this here? Oh, yeah, sorry, 1 second here. Oh. So this capital loss will basically be denied. This will be known as a superficial loss. So this is a superficial loss, so the capital loss will be denied. What will happen is that in 2024, we have the purchase of 100 shares at 23.20. So that's going to be $2,320. What will happen then is that this superficial loss that was denied will get added to the cost base of the new shares. So the new adjusted cost base the new ACB, or should I just put that here? New ACB is going to be 2,420. So it's kind of the opposite of what we did before the break. Before the break, we had gains that were deferred. This loss is being denied because they can't deduct the loss in 2023. It's just going to increase the cost of the new shares. And if you think about it, if we increase the cost of the new shares, that means when we sell them later on, the gain will be lower as a result of that additional amount added to the cost base. So then when the shares are later sold on June 1st, 2024, let's see what happens on the sale then. So we sell the shares for $26 now. So our proceeds of disposition are going to be $2,600. We minus the adjusted cost base, which is $2,420. The capital gain then will be $180. So once again, we now use this new adjusted cost base, which includes the superficial loss that was denied. And that's going to increase the cost base. So when we sell these shares, it's going to lower the capital gain. And so the taxable capital gain will be 50% of 180, which will be $90. So this is sort of important to know that this rule does apply. Even if the taxpayer, didn't plan to do this for recognizing the capital loss. Let's say they sold these shares at December 20th because they thought, oh, the value is going to go even lower. Later into January, they realize, okay, maybe it's hit rock bottom and they buy it back. Even though their intent wasn't to try to realize this capital loss, this superficial loss will apply. And once again, it will deny the capital loss. And that loss that was denied will basically just increase the cost of the new shares. Any questions about this superficial loss rule? So the next topic we're going to look at deals with capital gains reserve. Now, this may sound similar to the reserve that we talked about in Chapter 6. If you remember in Chapter 6, we talked about those 3 tax reserves. The reserve for doubtful debts, the reserve for undelivered goods and services. Those ones we had the same for accounting and tax. But it was that third reserve where we had that installment sale. We sold a really expensive inventory item and we got paid over a few years. We got to take a reserve. This is similar, but this relates just to the sale of capital property. So this is different from Chapter 6. Chapter 6 dealt with selling inventory where we got paid over several years. This is selling capital assets where we recognize a capital gain, but we get paid over several years after the sale. So it allows us to take a reserve. And the same rule applies. If you remember the rules with reserves, if we're eligible for a reserve this year, we deduct the reserve. And then next year, we add back last year's reserve. And, whoops, oh, shoot, that erased that whole sentence. Hold on, let me just retype that again. So the rules with reserves is that if eligible, we deduct the reserve this year. And then next year, we add back last year's reserve and then determine if eligible for a new reserve. So once again, if you remember back in chapter 6, the way that reserves work, if we're eligible for a reserve this year, we deduct it, but then next year we have to add back last year's reserve and then determine if we're eligible for a new reserve that we can deduct in the new year. So the reserve that we can deduct is based on the lesser of these two amounts here. So let me just sort of put this in yellow here. So the reserve is the lesser of these two amounts. We're going to go through the calculations using an example. Once again, the best way to sort of put this into perspective is looking at an example. And so this reserve would apply to, individuals and corporations. If they sell a capital asset, they realize a capital gain, and the payment for that sale is spread over a number of years. So we have this company, BMP, they purchase a plot of land. The cost is $150,000. They bought it in 2020. In 2024, they realized that, no, we're probably not going to need that piece of land, so let's just sell it. So in 2024, they sell it for $400,000. So right away, we know that they have this capital gain of $250,000. Now, the $400,000 was not paid all at once. They got $150,000 in February 2024, and then the remainder of $250,000, they got in equal installments, 2025, 2026. So let's just sort of summarize what we know. We know that in 2024, we have this capital gain. Oops. In 2024, we have this capital gain. We're going to take our proceeds minus our adjusted cost base. And the proceeds again was $400,000. The adjusted cost base was $150,000. So we know that we have a capital gain of $250,000. And that's what we have to report in 2024. This 400,000 though, this 400,000 here, we received 150 in February 2024. And then the remaining 250,000, we got 125 in February 2025, and then the other remaining 125 in February 2026. Let's just make sure that adds up to 400, 150 this year, 125 next year, 125 the year after, and there's our 400. So in 2024, we're going to have to report a capital gain of 250. Once again, 50% of that is taxable. But the reserve that we calculate in this yellow here, the reserve is based on the capital gain amount. So if we're eligible for a reserve, we will minus the reserve here. And then we'll figure out how much capital gain we have to report this year. So what we're trying to do is figure out what is this reserve that we can take this year, if any. So let's look at the formula in yellow. The 2024 reserve is going to equal the lesser of two amounts. The first amount is going to be the capital gain. So I'm just reading the yellow information above. The capital gain is 250. multiplied by the ratio of proceeds due after the end of the year to the total proceeds. So how much of the 400 have we not yet received? We have not yet received 250,000. And what's the total proceeds? 400. So the first amount will be 250 times 250 over 400. That's going to be 156,250. What is the second amount? The second amount is the capital gain, 250, multiplied by a percentage, which is 20% times 4 minus the number of preceding tax years ending after the disposition. So it's just basically saying how many years have elapsed since the disposition. So we're currently in 2024. Have there been any sort of full years that have elapsed since the disposition? No, because we're still in the same year as the disposition. So this would be 0. Basically, this is going to be 250 times 80%, which is 200,000. What this second part is trying to do is trying to say that you have to recognize at least a minimum of 20% a year over a 5-year period. So we'll sort of see that when we get to next year as well. But what this is saying is that the capital gain is your 100% amount. So the capital gain is your 100% amount. The second part of this calculation is 80% of the capital gain. So if you get to take an 80% reserve, you must include 20% of the capital gain in every year. So that's what the second part of the formula is saying that at a minimum, even if you were not to get any proceeds for, let's say, 8 years, let's say the 400,000 will not be paid until after 2032, you still have to include a minimum of 20% a year over the next 5 years. That's what that second part of the formula is. But in this case, the lesser of the two is not the 200,000. The lesser of the two is the 156,250. So we only get to take a reserve of 156,250. So what that means is in 2024, we have to include 93,750 of the capital gain. And once again, only 50% of that will be taxable. So let's just, only 50% of that will be taxable. So the taxable capital gain that we will be reporting in 2024 is going to be 46,875. So we're only including 93,750 of the 250,000 capital gain. So remember, the total capital gain was 250. So we're including 93,750 this year. Any questions about 2024? What then happens in 2025? So in 2025, we're going to add back last year's reserve. So we have to add back last year's reserve, 156,250. And then the question is, can we deduct a new reserve? So let's figure out then what is going to be the 2025 reserve. The 2025 reserve is going to be the lesser of those same two amounts. But the amounts will be different now, because if we look at the first amount, and once again, we read the amount in yellow, the capital gain multiplied by the outstanding proceeds divided by the total. So in 2025, whoops, 250 times, in 2025, we would have collected the 150 and the 125. So there's only going to be 125 outstanding at the end of 2025. We divide it by the total proceeds of 400. And if we work through this calculation, this is going to give us 78,125. The second part of the calculation, we take the capital gain, multiply by 20% times 4 minus the number of preceding years. So there was 1 year that has passed, so 4 minus 1. So this basically will be 250,000 times 60%, and that's going to be 150,000. So remember we said that the second part of the formula forces us to include at least 20% a year. And so let's say that the second amount was the lowest. So once again, last year we had to include 100%. If the second number was the lowest, that would mean an 80% reserve. And so we only include 20% of the capital gain. If we add back the 80% next year and we deduct the 60%, once again, saying that the second amount was the lowest, we would be including another 20% in the following year. So once again, this second component here basically says, even if you're not going to get payment until years later, at a minimum, you have to include 20% of the gain every year. But in our example, the lesser amount is not the second amount, it's the first amount. So the new reserve in year 2 in 2025 will be 78,125. So we get to deduct the new reserve, 78,125. So the capital gain that we will have to recognize in 2025 will be 78,125. Let's just bold that or highlight that. And the taxable capital gain will be multiplied by 50%. So taxable capital gain of $39,062.50. Any questions about 2025? So let's go to 2026. So 2026, same thing. We've got to, I'm going to copy and paste because that should be the same. We're going to add back last year's reserve. So last year's reserve, 78,125. And then we got to figure out, can we take a new reserve this year? And you probably know that the answer will be no, right? Because everything has been received. So let's look at the first calculation, 250 times how much is outstanding that we haven't collected yet at the end of 2026. At the end of 2026, we would have collected everything. So there's 0 outstanding proceeds divided by 400,000. So this would equal 0. Now the second calculation doesn't really matter, but let's just do it anyway. 250 times 20% times 4 minus how many preceding years? 2. So this would basically be 250 times 40%. And that would give us 100,000. So once again, the second calculation doesn't factor in these examples here, just because we've been receiving the proceeds sort of at a quicker rate. But the lesser of the two for 2026 would be 0. So we wouldn't be able to take any reserve in 2026. So that would be 0. Oops. And so the capital gain that we would have to recognize is 78,125. Let's just highlight that. Once again, times 50%. And so the taxable capital gain would be $39,062.50. And once again, if you add up what we highlighted here, the 93,750 the 78,125, and then the 78,125 in 2026. That gives us the total 250 capital gain. So because of this capital gain reserve, we're spreading it out over 3 years because we're getting paid over 3 years. Any questions about the capital gains reserve? And so once again, the second part of the formula basically says that at a minimum, you have to take into account 20% a year, and that will be all recognized in 5 years. So 20% a year would be 5 years to recognize the full 100%. But once again, it's the lesser of the two numbers. And in our example, the lesser of the two numbers was the first amount. And so once again, that's the capital gain reserve. This kind of seems a little bit similar to the reserve we saw in chapter 6, but the reserve in chapter 6 dealt with inventory sales where you got paid over a period of time. This relates to capital gains when you sell a capital asset and you get paid over a number of years, then the capital gains reserve would apply. So I don't see any questions. We're going to move on now. We're actually on good time. I always concerned about chapter 8 because there's so much to cover, but we're on schedule. We're just before 8 o'clock, so we'll still get done in plenty of time. The last topic that I want to cover deals with personal use property and listed personal property. So personal use property, abbreviated PUP, and listed personal property, abbreviated LPP. So those are sort of the abbreviations that we commonly use. Personal use property and listed personal property. So personal use property used primarily for the personal enjoyment or use by the taxpayer. So when we talk about personal use property, things such as your home, furniture, your clothes, your car, that's all personal use property. So remember we said earlier when we talked about principal resident, if you sell your home at a loss, the loss is denied because it's personal use property. So whenever you sell personal use property, capital losses cannot be claimed. But if you sell personal use property at a gain, they are included in income. So most of the time, though, when you think about personal use property, it's going to go down in value. Generally, personal use property generally sold at a loss. So if you buy furniture, you use it for a few years, you move, you sell your furniture, you're very rarely going to make money on it, unless maybe it was a designer sofa, and maybe that designer maybe discontinued making furniture, and so becomes a collector's item. That might be the only time it might be sold at a gain. Clothing as well. You buy clothing, you sell it. Used clothing, you're going to sell it at a loss. Once again, same with a car. The only exception would be a home, but that's where the capital gains principal resident designation came into play. But if you do sell your home at a loss because it's personal use property, the capital loss cannot be claimed. What about listed personal property, LPP? Listed personal property is also personal use property. It's a subset of personal use property, but it's property that will generally appreciate in value. Now, there's a specific list as to what constitutes listed personal property. So listed personal property is only going to be these types of artwork. It's going to be jewelry. If you have a rare sort of manuscript or book, maybe a stamp collection or a coin collection. So those are the only assets that qualify as listed personal property. So antiques is not in here. So antiques may go up in value, but once again, antiques are not in here. So antiques, sort of antique furniture, antique chinaware, that is not under listed personal property. Listed personal property only are these assets that are listed here. So with listed personal property, capital losses are allowed, but capital losses on the sale of listed personal property can only be claimed against capital gains on listed personal property. So we're just going to go through an example to sort of clarify this. There's also this minimum 1,000 proceeds and minimum 1,000 adjusted cost base rule that applies to both personal use property and listed personal property. What they're saying is that even if you were to sell a personal use property at a gain, we want to sort of weed out any small gains and losses. So we're going to set the minimum proceeds at 1,000 and the minimum adjusted cost base at 1,000. So if you sell it, let's say you sell it for 700 and the cost was 200, generally you would have a gain of 500. But because of this minimum 1,000 proceeds and minimum 1,000 adjusted cost base, it will reset these amounts to the minimum 1,000 and eliminate that gain altogether. So that's all that the minimum proceeds and minimum cost rule says, is that we want to sort of eliminate any minimal amounts that you don't have to worry about. So we're going to set the minimum proceeds at 1,000 and the minimum cost at 1,000 as well. So let's just sort of see how these rules apply to this scenario here. So Mike sold the following personal use property during the year. So remember, LPP is a subset of personal use property. So that's listed here are personal use property, but some of them may be LPPs. So let's sort of see what we have here. We have a painting. Is a painting a listed personal property? It is. Painting right here. We have a stamp collection. Stamp collection is listed personal property. So the first two are listed personal property. The outboard motor, that's not on the list, so that's personal use property. And remember we said antiques. Antiques, unless they're listed on the list, if they're not listed on the LPP list, then this antique desk is also personal use property. So if we sort of look at this here, we sort of have to split it now into these two here. Listed personal property at the top, and then the last two are personal use property. And then we have to apply the minimum 1,000 rule. So if we look at the painting, it was sold for $2,500. Because of the minimum $1,000 rule, we're going to change that to 1,000. So because of the minimum $1,000 rule, we're going to change that 800 to 1,000. And so now we have a gain of only $1,500. So we're not going to have a gain of 2,500 minus 800, which would be 1,700, because of the minimum proceeds and minimum adjusted cost base of 1,000 rule. The gain is only going to be 1,500. What about the stamp collection? Now we sold this at a loss. Remember we said that capital losses for LPPs can be claimed, but only against LPP gains. So because we sold it at 600, that's below the 1,000. So let's also remove that, and we'll put just move this over. So this will now be 1,000. And so once again, we're going to have a loss of 200. So it's going to work against you as well. The loss here would have been 600, but because of the minimum proceeds and minimum cost rule, the proceeds will be changed from 600 to 1,000. So it can sort of also work against you to reduce the losses as well. So the loss will be 200. What about for the outboard motor? We can sort of see from the outboard motor, they sold it for 900 and the cost was 100. So they actually made $800. But once again, because of that minimum $1,000 rule, we can strike out the 900 and we can also strike out the 100 here. And both of those amounts will now be changed to 1,000. So the gain will be 0. So that works out in their favor because once again, the reason we have that minimum amount is to sort of weed out any of these small gains. And so even though they did have a gain at 800, it will be all eliminated because of the minimum 1,000 rule. With the antique desk, they do have a loss. So with the antique desk, they do have a loss. But remember, these losses on personal use property, they are denied. So this loss then will be denied. PUP losses are denied. So that loss will be completely gone. It will not be allowed. So no capital gain on the outboard motor because of that minimum 1,000 rule. The loss on the antique desk will not be allowed because it's a personal use property loss. So those are denied. So the only thing they have to worry about is to report the gains and losses on the LPPs. So what will happen then is once again in 3B, we have the capital gain of 1,500 times 50%. So that's going to be 750 taxable capital gain. And then we have the $200 loss times 50%. That's going to be 100 allowable capital loss. But remember, this loss here the LPP loss can only be used to offset LPP gains. So it can only be used once again to offset the 750. So what will happen then is that the net taxable capital gain will be $650. So that's how much will be included in 3B is the $650, the 750 minus the 100. If we did not have this 750 here, if we did not have this 750 here, the LPP loss can be carried over, but it can only be carried over back 3, carry forward 7, and can only be used against LPP gains. So let me just sort of make a note here. If there was no 750 LPP capital gain, then the 100 LPP loss could not be claimed this year, even if there were other taxable capital gains. The LPP, sorry, on here. So if there was no 750 LPP capital gain, the $100 LPP loss could not be claimed. Then they would have a $100 LPP loss carryover, and it could be carried back 3 years, carry forward only 7 years, and offset LPP taxable capital gains only. So that's how LPP losses work. They can only be used against LPP gains. If there was no LPP gain this year, the $100 allowable capital loss could be carried back 3 years, carry forward 7, but can only be used to offset LPP gains. Any questions about personal use property, listed personal property?
Yeah, I'm just curious, for
Mhm.
carrying back, is
Mhm.
there is there a certain adjustment you make, like a return adjustment you submit to CRA to
Yeah,
that
yeah. So
carry
so
back?
let's sort of look at this example here. So that's a good question. So let's just assume that copy. So let's just sort of put sort of a line here. So we can just sort of separate what we've already discussed and set that apart. So if there was no LPP gain this year, and we had this $100 LPP loss carryover, and so let's say this was 2024. Let's say this was in 2024. Let's say in 2023, we had an LPP taxable capital gain of, let's say, $700. So what we could do then is, in 2023, we had to pay tax on this LPP taxable capital gain. In 2024, we have this LPP loss carryover. We can carry it back 3 years. So what we could do is, after we file the 2024 T1 return and establish the $100 LPP loss carryover, we can file a T1 adjustment for 2023. And on that T1 adjustment, we would carry back the $100 LPP loss and reduce the 2023 taxable capital gain from 700 to 600. So that all can be done using what we call a T1 adjustment. So the T1 adjustment is basically just a form indicating what year you want to make the adjustment for and what types of adjustment you're going to be making. And so we can say we're going to make the adjustment for 2023. Initially, we reported a capital gain relating to LPP dispositions of 700. That was the taxable capital gain. We're now going to carry back this $100 LPP allowable capital loss, and that's going to reduce the gain to 600 in 2023. Because we already pay taxes on it, once we file the T1 adjustment, we'll get a small refund because of that loss carryback. Does that answer your question, Sam?
It definitely sounds good.
Yeah, perfect. Any other questions? And once again, these are really good questions to be asking. So if there are any other questions about how this would be done administratively, please let me know. I don't see any other questions. I want to just talk a little bit about sort of what's coming up. So let me just save this. I'm going to bring up eLearn quickly, which is right here. So once again, as I said in eLearn, I posted this court case here that relates to principal resident. It's quite an interesting read. It's fairly short. It's only about, I think, maybe 2 or 3 pages. I think some of it was maybe cut off a little bit because I printed it from the internet. But if you did a quick Google search on the Tax Court of Canada, principal resident, and then the taxpayer's name Hansen, you'll find different law firms that sort of summarize this court case. Quite an interesting read about how the CRA went after this taxpayer for using the principal resident exemption when they bought and sold, I think it was 5 homes over a course of about, I think, 6 or 7 years. What's coming up? So the homework that's coming up, where is that here? Oh, sorry, it's on the side here. There is still going to be homework for chapters 8, 9, 10, and 11. I kind of set the due dates a little bit later because I know that we're getting to the end of the term and you probably have a lot of other projects, papers, presentations that are due. But since we did finish chapter 8 today, even though the chapter 8 homework's not due until Sunday, March the 30th, once again, go ahead and get it done sooner rather than later so you don't forget. I want to make sure everyone knows when the final exam is. So I did send the final exam link to the class in this message here on eLearn. The link is right here. So let me just sort of highlight this link. Let me go to it. This will bring up the CapU website for the registrar's office. Scroll down, the exam schedule right here. Click on that, the PDF file will open up. Oh, hold on a second. it's showing up on your screen. Here it is. BFin 1351. Here it is. So right at the top of this page here, BFin 351 online exam Wednesday, April 16th, starting at 6:30. So if you've been at CapU for a while, you know that evening exams start at 6:30. So even though the course starts at 6 p.m. during the term, the final exam will start at 6:30. So this is the first Wednesday of the final exam schedule. The final exam, I haven't written it yet, but it will be on eLearn, very similar to the format that we had with the 2 midterms, some multiple choice questions, and then some problems. The majority of the marks will be on the material after the second midterm, because there is a lot of material, chapter 8, 9, 10, and 11. So the majority of the marks will be on the material after midterm number 2. Some of the questions might rely on knowledge from earlier chapters. For example, when we did sort of those recapture calculations that related to chapter 5, CCA. So some of the knowledge does sort of filter over to these later chapters, especially chapter 11. Chapter 11, we kind of revisit taxable income, revisit tax credits. So there will be some sort of carryover of some knowledge, but the main focus will be on the later chapters 8, 9, 10, and 11. And once we get closer to the final exam, when we get closer to the last lecture, I'll give you more details about the final exam. But I just wanted the class to be aware of that because this will be one of the first exams that you'll have. Wednesday, April 16th, 6:30 p.m. online on eLearn. Any questions that I can answer? So that is it for today. We kind of finished a little bit earlier, which is good. Now you can relax for the evening. And next week, we're going to jump into chapter 9. And then we have sort of 3 more lectures to go, chapters 9, 10, and 11. That is it for today. Hope everyone has a good night. I'll post the completed handouts on eLearn, and I'll also post the Zoom recording on eLearn as well when it becomes available. So that is it for tonight. Hope everyone has a good night, and we will see you next Wednesday on Zoom. Okay, good night, everyone.
Thank you. Have a good night.
Bye-bye.